Hello and welcome back to our InvestED vidcast series. I'm Chris Sabula and I'm here today with Mark Armbruster. Mark recently wrote a white paper that will be published by the CFA Institute on its Enterprising Investor website. The paper addresses the challenges investors face today because of relatively high valuations in the stock market, but more particularly historically low interest rates in the bond market. Mark, in the paper, you're proposing a new approach to investing in bonds, but didn't a simple approach using a balanced mix of stocks and bonds work pretty well in the past?
It did work pretty well in the past. In fact, it's worked very well in the past. Investors generally need returns in the 7% range, both individuals and institutions, in order to meet their living expenses and their operating budgets for institutions. And by the time you figure in a 4% withdrawal rate and you tack on a couple of percent to keep pace with inflation and maybe another percent to offset the impact of fees, you've got a required return of 7% or so. And you've been able to get that with a pretty simple mix of stocks and bonds. You can see that on this table here. Down at the bottom, the returns from 1926 to 2019 annualized were 9% for a simple mix of 60% stocks and 40% bonds. Stocks got about 11%, bonds got about 5%. It worked out very well. And even when you look more granularly and you break this data down by decade, there were really only 2 decades in the last, whatever this is, 90 or 100 years, where you didn't get returns north of 7%. One was during the Great Depression, which was a highly anomalous period, and one was in the 2000s in the wake of the technology bubble bursting. And even there, if you had more diversification in the stock market, if you had some value stocks, you might have been able to get pretty close to that 7%. And so a simple approach did work pretty well historically.
So a simple approach has historically worked. Why are you thinking something is different today?
Well, looking forward, the market characteristics are a lot different today than they were historically. Both the stock and bond market appear to be pretty overvalued, or at least pretty highly valued. The stock market is trading at the third highest reading ever using the CAPE ratio, the cyclically adjusted price earnings ratio. And the yield on the bond market is very low. It's only about 60 basis points as we sit here today. And so there was a research paper done a number of years ago by a researcher named Martin Leibowitz who found that the current yield on the bond market is a really strong predictor of what your returns will be annualized over the next 6 or 10 years. And so if the yield on the 10-year Treasury is 0.6% today, you're not going to enjoy that 5% return that you've gotten out of bonds historically. You're probably going to get close to 0.6%, give or take a little bit. Trying to get that same 7% or 8% return that investors require out of their portfolio is unlikely because you won't get that 5% from bonds and you won't get that 11% from stocks. And so it's going to be much more difficult to garner the returns needed in the future.
Well, that doesn't paint a very good picture. Is there a solution? Do investors just have to accept lower returns in the future, or is there a way to kind of reach for higher returns?
Yeah, that's the big question these days, and nobody knows for sure what the answer is, but it is possible that we can stick with a more traditional approach, a simple 60-40 stock bond mix, and maybe stock returns will be strong enough to bail out the underperformance of bonds. That has happened before. We have very low interest rates today, as I said, and low interest rates are good for stocks. Stocks can support much higher valuations when interest rates are low. That happened in the 1940s and 1950s. The returns on the bond market were quite low, but the stock market was so strong in those periods that offset, and you still got returns that were above that 7% range. The problem today is I think that's less likely because stock valuations are much higher. In the 40s and 50s, that CAPE ratio was in the teens. Today, it's close to 28. Probably we're going to have to try to reach for more returns from the bond part of the portfolio in order to hit that target return. I don't think that we'll have any other way to get there. And I don't think it's appropriate to just say we have to settle for lower returns, even though you do read a lot about that in the financial media. I don't think that many retirees are able to scale back their lifestyles that significantly. And even more importantly, I don't think that a lot of organizations, whether it's colleges or nonprofit organizations, can drastically cut their operating budgets and scale back programming in order to accommodate lower returns for a decade. So I do think it's important to try to get as much return out of the portfolio as possible.
When you talk about reach, you're really talking about risk, right? And so what does taking more risk in bonds look like?
There's really 2 approaches to adding risk to a bond portfolio. One is by adding duration or extending the maturity of the bonds in your portfolio, buying longer dated bonds. and one is by taking credit risk, that is, bonds that have greater default risk. The problem is that neither one of those is likely to help today. If you look at this graph, interest rates are as low as they've ever been in 200 years. And when interest rates go up, that's bad for the price of bonds. Bond prices come down as interest rates rise. And if you have a long duration portfolio, long duration bonds in your portfolio, that damage is more significant. And so if you extend out and interest rates rise, even back to just sort of normal levels, you could experience pretty significant losses in your bond portfolio. The problem with credit is that there's a high correlation to the stock market. And so if we think that the stock market is a little overvalued today, or at least fully valued, and there's risk that it could go down in price, I'm not sure credit is the right place to be either. If you look at this graph, you can see the correlation between stocks and the credit component of bond returns has been over 60% historically. But if you look at that on a rolling 3-year basis, you can see it's been as high as 90% in the past, and it's pretty high today. By loading up on credit, you're really just loading up on stock market risk, which people already probably have a lot of in their portfolio, so there's no reason to double down on that.
So if you're not talking about traditional bond risks like duration and credit, what sort of risks are you suggesting we take in the bond market?
I think we need to be more creative. We also need to rethink overall portfolio management and risk control.
What does that look like?
I think first and foremost, we need to stop worrying so much about bear markets. When they occur, they don't occur that frequently, once every 10 years or so, and they tend to be relatively short-lived. The average bear market is only 14 months in duration. Maybe instead of holding 40% of our portfolios in securities meant to minimize losses during these periods that only happen once per decade, we should focus more on long-term growth and provide enough liquidity to survive those crisis periods. So let's think about what this would look like from a portfolio perspective. The longest bear market in history was the Great Depression, and that lasted around 3 years. We think it's unlikely that you'll see a bear market of that magnitude again because there's a lot of regulatory and risk controls that have been put in place since the Great Depression. But let's use that as an extreme example. Maybe if things go horribly wrong, the market could go down for a few years and then stay low for a couple more years. Let's think about a 5-year horizon for a downturn. And so if you have a spending policy or withdrawal rate of 4 or 5%, a 5-year crisis window implies that you might want to have 20%, 25% of your portfolio in ultra-safe liquid securities, such as treasury bonds. And that type of position would hold its value in a downturn. It might even go up if there's a flight to quality. You could see that those securities increase in value during a bear market and for stocks. When you need money the most, when you need liquidity and access to your capital, it would be easy to sell these securities, or you could build a laddered portfolio of them so that they come due with some frequency so you get the cash that you need.
So we have 20 to 25% of our portfolio held in these safe securities. How would you recommend investing the remaining 15 to 20%?
I think we need to expand the definition of bonds to be more of an alternative fixed income type of approach. You still get some risk control. In a normal market environment, the risk of such an approach is about the same as if you did high-quality bonds in a 60-40 portfolio, but you can get better long-term expected returns. The overall portfolio volatility is about the same, but you would take on a little greater risk in a down market. But again, I'm not sure that matters because you've got the treasuries there to protect you and provide the liquidity that you need when you need it the most.
What are some examples of these types of investments?
We've been using catastrophe bonds, private loans, and multi-strategy alternative bond funds. There's certainly other opportunities as well, but these are 3 that we've been using in our portfolios.
Maybe you can expand a little bit on those.
Sure. Catastrophe bonds provide a return for bearing the risk of natural disasters or other insurable types of risk like airline disasters or marine disasters or ice storms or hurricanes and that sort of thing. The nice thing about these investments is that they don't have any economic exposure at all. And so if you have a recession in the United States, it doesn't mean that there's going to be a hurricane in Florida or an earthquake in California. Similarly, if you have a bear market, it doesn't mean that there's going to be a natural disaster caused by that. And so they truly are independent returns. In fact, the main index for catastrophe bonds is the Swiss Re Cat Bond Index, earned positive returns in both 2002 and 2008 when stocks were really down a lot.
What about private lending?
Private lending involves buying loans that don't trade on a normal exchange. So they might be student loans, small business loans, personal loans, and perhaps some other categories as well. The yields for these investments are typically quite high, but they're all often offset by expenses that are also quite high. despite those platform fees and all the other layers of expense, you can still expect a net 5 or 6% from these types of investments over time. The nice thing about them is the duration is generally really short. The loans tend to be 3 years or less in term. And so the interest rate sensitivity, that duration risk that you get with traditional bonds, is largely absent in private loans if they're structured properly. There is still risk, though, to these investments, and it comes in the form of defaults. If there's a really bad recession and unemployment rises, people aren't able to pay back their loans. And so you see defaults rise, typically in line with credit card charge-offs over time. Multi-strategy fixed income funds apply various means of achieving what are really engineered returns that have return streams that have low correlation to traditional stocks and bonds. Expected returns can be higher than the overall bond market, and that's often because of the types of investing they're doing. They are sometimes taking on more risk. In some cases, they're even investing in stocks, more defensive equities in both a long and short way. And so these funds aren't exactly pure plays on the fixed income market. But in a lot of ways, that's the point. If we were just buying traditional pure plays on the bond market, we'd be settling for lower returns. So I do think we need to expand our definition a little and become a little more creative in how we approach this. And I think these alternative types of approaches are necessary today.
So using those 3 examples that you just mentioned, how would that approach compare to a traditional 60-40 stock bond portfolio? Is there data to support investing in these vehicles?
There's some. Unfortunately, a lot of these investments are newer, and so there isn't a long, robust return history available for everything. But we can get data for some of them going back 20 years. Unfortunately, 2016, the middle of 2016 is as far back as we can go on all of the funds that we use to represent these asset classes. And when we use them, when we look at that return history, an equal weighted portfolio of these 3 investments would have given you returns that were just a little bit above the Vanguard Total Bond Market Fund. So you kept pace. You got 4.7% with an alternative bond portfolio versus 4.1% for a more traditional approach. And that was during a period when interest rates were coming down, which really favored traditional bonds. Interestingly, though, the standard deviation was lower for the alternative portfolio, only 2.6% versus 3.5% for the total bond market fund. And I think more interesting still, or most compelling, I should say, is that the returns so far in 2020 have been flat for the alternative bond portfolio. Now, that's not as good as what you would have gotten with traditional bonds, which were up 5%, but this was in a crisis period for the stock market and for the economy. You would expect that flight to quality that we talked about. You would expect traditional bonds to fare very well, and they did. They were up in value. But for these alternatives to even hold their value, I think is a real victory and a lot more promising than what you see with other alternative types of asset classes.
Would this type of approach met the required returns we discussed earlier, that spending policy, that 7 to 8%?
They would have historically. Looking forward, it's certainly not a layup, but I think they give you a fighting chance. If you were to swap 50% of the traditional bond portfolio for an alternative fixed income approach, I think your expected returns over time would rise to maybe 3.5%. That's not in line with the 5% historically you've gotten from bonds, but it's a lot better than the 60 basis points that we think you're going to get going forward. And so in order to get to that 5% expected return that we'd like to see out of bonds, you really need to put 75% of the bond portfolio into this alternative approach. That still leaves a quarter of it in high-quality treasuries, which probably is enough for most investors to provide the liquidity they need in relatively short-term downtrends in the stock market. If these funds truly hold their value in a crisis, having less invested in treasuries would be a practical approach and would further minimize long-term performance drag from holding ultra-safe bonds.
So the bottom line seems to be that while long-term data for this mindset shift you described isn't really available, there's at least some evidence that we can safely reach for higher returns with fixed income-like instruments without completely abandoning prudent control or risk control?
Yeah, that's right. This is not a perfect approach. We'd love to have more data, but waiting for more data that really proves that this approach works is a luxury we don't have. There's real-world risks out there that long-term portfolios face, and we need to do something to address it today.
Thanks, Mark, for joining us today to talk about your paper. We also want to thank all of our listeners to our InvestED series. We look forward to having you join us again soon for our next edition. And as always, please reach out if you would like to discuss any of these topics in more depth or just let us know if you'd like a copy of the recent white paper on redefining fixed income.